Right now, Asia is going through the largest handover of family businesses in its history, and the rules for that handover are being rewritten while it happens. On August 3, 2026, Korea announced its 2026 tax reform. The minimum period a business must have been managed to qualify for succession relief goes from 10 years to 30. Families who planned around a 10-year rule now need 30. For a founder already in their 60s, that can put the relief permanently out of reach. And Korea isn't alone. Japan expects 600,000 profitable businesses to close for lack of successors. In China, 85% of private enterprises are family-owned, and the first generation is stepping back now. Here's the structural problem. When a business sits directly in one country, its succession is governed by that country's rules. And those rules move. A holding company changes what gets transferred. Instead of moving assets in 5 jurisdictions, each with its own inheritance rules, you move shares in one company. Singapore is a common choice. No estate duty, no tax on capital gains from local assets, and a wide treaty network reducing withholding on money moving between subsidiaries. But structure alone isn't enough anymore. Since January 2024, Section 10L means a Singapore holding company without real substance here can be taxed at 17% on gains from selling foreign assets. And IRAS is blunt about it. Foreign-owned investment holding companies are generally not considered Singapore tax residents, because they usually act on the instructions of their foreign shareholders, which means they're generally not eligible for a certificate of residence. IRAS may still issue one if you show 2 things: that control and management of the business is exercised in Singapore, and that you have valid reasons for setting up an office here. Then you need one of 3: a director based in Singapore who holds an executive position and is not a nominee, or a key employee here, a CEO, CFO, or COO, or management by a related Singapore company. Control is shown through your board. Meetings held in Singapore, where strategic decisions are made. If they're virtual, at least half your directors or the chairman must be physically in Singapore. And the test cuts both ways. Many countries apply a similar place of management test. If your board actually meets in Jakarta, that country may claim the company as its own resident, and you file in 2 places. Residency is assessed every year, on the preceding calendar year. It isn't granted once. It can change the year your directors stop flying in. The structure takes a week. The substance is the part that has to be real. So, 3 things to remember. Korea just raised its succession threshold from 10 years to 30, and it won't be the last country to tighten. A holding company means you hand over shares in one company instead of assets in 5. And in Singapore, that only works if real decisions are actually made there. 3 points that decide whether a handover survives the next set of rule changes.